Hi, it's Dave. Tesla stock is on a complete rampage over the past month. It broke $400, watch my video on that. It broke $500, I posted another video on that, and now it's closing on $600. And with all this hype, people are asking, should I sell my Tesla shares? In this video, I want to share what my Tesla exit plan is. This is my own personal opinion. I don't know your own individual personal financial situation, so I can't give specific advice toward that. So make your own decisions. It's your own responsibility. That said, I want to first take a look at this idea of an exit plan. Conventional trading and conventional wisdom often promote this idea that you need an exit plan so you can save and preserve your profits. Wall Street has a saying, bulls make money, bears make money, but pigs get slaughtered. In other words, the moral of the story is to take profits while you have profits. And it's often driven by this fear of losing out on your profits, but not just on your profits, of losing out on your principal of investment too. The focus sometimes is often short-term and just trying to save and preserve what you get. So when the stock runs high and people are excited and you've doubled your money or so, you better be pulling your money to save those profits. Now that's conventional thinking and conventional investing. However, I have a different approach toward this. And my approach is that I'm in it for the long term. If I can find a company that I think has a clear path to a 10x gain within 5 to 10 years. In other words, I'm looking for a one-in-a-kind, a generational company that has a clear kind of probability to execute well and to gain a 10x market cap, meaning if the company is worth $1 billion, that they can be worth $10 billion or even more within a 5 to 10 year period. And the reason why I'm focused on searching for these type of companies is because first, I think they're out there. And if you look at history, there are many examples of 100x companies, companies that have gone from $1 billion to $100 billion. And if you can get into a generational 100x company, and the way I believe you first get into a 100x company is you start out with a 10x investment. For example, if you get in at 1 billion and the company goes to 10 billion, and the company is still doing well, it has potential to go up to 100 billion if it's the right company. And then before you know it, it's possible to have a 100x investment. Now these 100x investments aren't kind of like taught in conventional investing. And that's part of the reason why I have this channel. I'm not expecting everyone to easily find 100x investments, but I believe with the internet and with more information and with the right strategies and principles in investing, we can uncover these large high growth investments. They might not be a 100x for you, but they might be a 5x or a 10x over 5 to 10 years. So this is kind of the focus of my investment and my investment strategy and this channel as well. Now the 4 criteria of this 10x investment company that I'm looking for is first, I'm looking for a company that's disrupting a large market. And it's important that it's a large market because the company will need room to grow their revenues. And without growing their revenues, they don't have a chance to grow their profits, which is going to increase their market cap. Second is I'm looking for a company that has a significantly better product or service than anyone else there in the market. And I think that has the ability to defend that superiority of their product. Oftentimes, this is evidenced by an amazing and deep love of customers for that product. A great example is, Apple back in the day when the iPhone first came out. Thousands of people were lined up first day buying the iPhone. I was one of them actually. And that type of customer love and appreciation is not easily found. Tesla is another easy example. People love their Teslas, and it's just completely uncommon in the auto industry to love a car and to appreciate it as much as a Tesla, I think. And I don't think it's easy to do that, to make a product that is superior in almost every way compared to the competitors. That's an extremely difficult job to do. And oftentimes, the only way you can do that is if you have the advantage of a disruptive technology that is giving you kind of a superpower. As you use a new technology, it helps you to improve the customer experience or improve the product or service. The third criteria I'm looking for in a disruptive company that can 10x within 5 to 10 years is world-class execution. Now, I'm looking for a company that is able to execute at a level with the best companies in the world. And this is super important because if a company is going to grow and grow over time, they're going to start entering into other markets, adjacent markets, and bigger markets that are already entrenched by larger companies and competitors. Now, if this company can't go head to head and beat the best companies out there with execution. When they start going into adjacent markets and larger markets, they're going to get beat out because they can't execute as well. Example is like GoPro. They had an interesting, first product of action camera. And I don't think their execution was good enough where they could compete with the Apples of the world to invent new products that can compete with the best of the best. The last criteria is number 4 is I'm looking for companies that have a clear path to a 10x valuation within 5 to 10 years. I'm basing a lot of this off of revenue projections that I'm making. You can go ahead and believe like people on the internet, believe people on websites and forums that say that this company is going to have like $1 billion or $100 billion by a certain date, but it really takes like some discipline and some basic skills to just draft a simple spreadsheet and to say, okay, these are the number of units I could see this company selling at this price, getting this type of revenue for the next 5 years. And they're going to make, this type of margin and therefore this type of profit. And I think that the multiple that investors are going to give is this. And I'll share more about how to make these evaluations in this channel as we progress. I also think it's better if the CEO has stated also this type of vision of a market cap projection. In other words, Elon Musk back in 2012, he had a CEO incentive plan that if Tesla reached $40 billion and with different milestones, he would get basically stock options. And when Tesla released that, it kind of showed a clear path of valuation that Tesla can go from a $3 billion market cap to $40 billion market cap by 2018 or so. And it was very reasonable in my opinion because by 2013, early 2013, Tesla had already won Motor Trend Car of the Year for the Model S. And people were loving their car. And it was like probable that Tesla would stick around. And it was probable that Tesla would release a Model 3 successfully and achieve a $40 billion market cap. And this is when Tesla was at under $4 billion. And so for Tesla to basically release this plan of a 10x valuation out in public, and there's a clear path, and they weren't making a ton of assumptions. They were, being optimistic that they could execute on new vehicles like the Model 3. But in my opinion, it was very probable and very likely, and I thought that was a great opportunity to get in. In 2012 and 2013, that's when I put in as much as I could into Tesla because I felt like they had a clear path to a 10x valuation within 5 to 10 years. Last year, Tesla also released a new Elon Musk CEO incentive plan, taking Tesla up to $650 billion with different milestones also that Tesla needs to reach. Now with that CEO incentive plan, it's another clear path to a 10x valuation when Tesla was back at $50 billion or so. The Tesla could go to $650 billion based upon kind of a clear path of growth, with revenue growth, with unit growth, sales, etc. And it's very helpful when a CEO or a company can release kind of a 5 to 10 year plan that shows a 10x valuation, because you can evaluate that and say, okay, what's the probabilities now, right? And how do I evaluate this 10x kind of proposition that this company has made? In general, if a company has these 4 characteristics, I'm holding stock, let's say I've bought into the company, as long as they continue to hold these 4 characteristics, they're disrupting a large market, they have a significantly better product or service, they have world-class execution, and they have a clear path to a 10x valuation in 5 to 10 years. As long as they're continuing to hold these characteristics, and I'm continuing to hold that stock. In other words, I might sell, a little bit just here or there on an annual basis just to raise some cash for some spending things that I need. But generally speaking, I'm not really selling much of my long-term holdings of Tesla because I think that this company is still executing and it's still going higher, in my opinion, in the long term. Now, let me give you an example. In 2003, Tesla stock went from $32 in the beginning of the year to $194 within 8 months. That's a 6x gain. Like, it's hard to imagine that kind of right now in 2020, but back then, if you bought Tesla at $32 or even lower the previous year, and your stock had gone up 6 times within 8 months, people were stunned and shocked. And most people I know at that time exited their Tesla holdings because it just felt like it was just too insanely high. Back then, I held on to practically all my Tesla holdings because it still met my criteria. they were still on the path to $40 billion market cap within 5 years or so. And already in 2013, as Tesla was making this big move, I was researching Tesla's possibilities of becoming the world's largest automaker, meaning not stopping at 40 billion, but could they go up to 200, 300 or more billion dollars in market cap? And so in 2013, that was my major focus in research. And I thought that Tesla was still getting started. It was just the end of the first inning back in 2013. A couple other reasons why I didn't want to sell in 2013 when Tesla made its 6x, like crazy run, was I need to pay taxes because most all my Tesla holdings is in my personal account and I have to pay tax. Another reason why I didn't want to sell in 2013 is because it's difficult sometimes to get back into the stock once you've sold. You know, there's a psychological thing where you don't want to buy in sometimes at a higher price and sometimes the stock can go higher. In 2013, October, it dropped back down to $116. Now this was like a devastating drop back in 2013. Imagine the stock was at 192 and it dropped to $116. It really felt like the floor was dropping. But then a few months later, in February 2014, it was back up to $265. Let's take a hypothetical type of situation. What if I did time the market in 2013? Let's say I did get out at $194 per share. I would have had to pay taxes on my capital gain. And let's say hypothetically, in June 2019, I timed it perfectly, which I don't think is even possible generally, but I bought back into Tesla stock at $177 just recently. I could have had 6 years of investing Tesla stock money that I pulled out into other companies. You would think that that would be a great idea, but here's my kind of problems and why I doubt that type of strategy. First, for me personally, I spent years looking for a 10x opportunity in 2012 with Tesla. And so for me, it's not like I'm trying to pick like stocks that, you know, I read about from, you know, some stock picker or whatever, and I just pick another stock. No, I'm researching for years and years on companies. I'm going deep into a lot of factors. And for me to find a 10x opportunity, there's an immense amount of time and energy that goes in. Now, the second doubt on this strategy of just trading in and out is my strategy is more, I want to hold on to as many shares as I can on the company long term, especially because I think it's a 10x company within 5 to 10 years. And the third reason that I doubt this kind of in and out strategy is if I sell, I'm paying a high tax on my capital gains. And now when I get in, I have to get in with less amount of money. Now, if you have holdings that are in a tax-free account, now that could be different because you could, you know, sell your shares without incurring a tax penalty. But in my case, I'm incurring a tax penalty when I share. Therefore, I have less amount of money to buy back in. So therefore, I'll probably have less shares if the stock continues to go up. So in my situation, I concluded it's better to hold. And that type of reasoning is kind of the reason why I continue to hold. You know, Tesla broke $400 just a month, you know, last month, and it broke $500 this month, and it's closing in on $600, and it crossed $100 billion market cap. It eclipsed VW's market cap. Now Tesla is the second most valuable auto company in the world. And the question is Tesla overvalued? But in my opinion, there's lots of volatility. Tesla can go up and down. Hey, Tesla, who knows? It could go back down to 500 to 400 to 300. I don't know what Tesla's gonna do in the near term. But in my opinion, there's a clear path to a $650 billion valuation within 10 years, which is, you know, by 2028, that's the Elon Musk CEO incentive plan. And I'm not going to declare that this is something for sure that's going to happen because there's always unknown risk at play. And that's something always to factor in. But for me, as long as the company is executing and it has the core criteria that makes it a disruptive company on the path for a 10x gain, then I'm pretty much holding on to that holding. The 4 things that are still in play for Tesla as a company is 1, they're disrupting a large market. It's a ridiculously large market. 2nd, they have a significantly better product or service. 3rd, they have world-class execution. And 4th, they have a clear path to a 10x valuation within 5 to 10 years. Lastly, I want to encourage you to subscribe to my channel. This stuff is kind of what we're talking about, you know, how to view investments, how to view personal finance, how to take a different out-of-the-box look at things from different angles, look at things objectively, not just be swayed by the subjective, emotional opinion of the masses or what's in the media, but to really take a sober, kind of honest look at some of these things and to make decisions that I think can really be impactful in one's life. I want to share one last thought regarding all this stuff. And this thought is, sometimes you run across a company that really executes and really delivers on their vision, kind of like a Tesla delivering on the Model 3, which I think they over-delivered. They just delivered a fantastic car that I think is still underrated, in most circles today. With these generational companies, add in Apple and Google and Amazon, etc. They're oftentimes run by these innovators who can really create new markets, and they can create a new product line, and they can enter into kind of adjacent markets. And so with these generational companies, it's difficult to keep them in a box, and it's difficult to say, hey, they're just this type of product and I can't see them being valued higher than what I imagine. And that's the thing, we can't predict everything. Who would have predicted when the iPod first came out under Steve Jobs that would have led them down the road to make the iPhone, which would be basically over half their market cap valuation to this date. You see, with these generational companies, they have compound revenue growth, and that grows their profits and their valuation, and then they can reinvest a lot of their profits and cash flows into more innovation and into more markets, into more products, which does the whole thing again, which increases revenue, increases profits and valuation. Please share this video with others. Go to your favorite Reddit, Facebook group, forum, to your friends. It's really gonna help to get the word out, and I will see you on my next video. Thanks.